Well, Starbucks says it is closing underperforming stores across North America. Starbucks Janela to close possibly up to 200 of its Canadian stores. I'm surprised and disappointed. Saturday was the final day for this store. This is a neighborhood spot, so it's kind of sad that they're closing. Sunday, the drapes pulled down, the place deserted, and the doors locked. No, Starbucks is now shutting down stores across Canada, and almost no one saw this coming. Not at this scale and not this fast. What looks on the surface like a simple business adjustment has erupted into national backlash, with Mark Carney himself sounding off as communities wake up to boarded cafes where their daily coffee stop used to be. But beneath the headlines sits a deeper, more uncomfortable truth. One built on collapsing demand, economic strain in a marketplace so tight that even global giants are quietly backing out of Canada. Gentlemen, when we look at the biggest loser today, it's going to be Starbucks. It's among the worst performers in the S&P 500. It's down double digits. There's no question that the occasional customer is cutting back on visits to us. We have not been able to communicate to them the value that we provide. Jeremy, with over 38,000 stores worldwide and nearly $36 billion in net revenue, it's one of the most recognizable brands in the world. Before we go any further, we need to understand the size of the company we're talking about here. Because Starbucks isn't a small neighborhood cafe that can disappear unnoticed. This is a global powerhouse with nearly 38,000 stores worldwide and billions in yearly revenue. A brand so dominant in North American coffee culture that it practically owns the entire morning routine. And yet somehow this same giant is pulling out of Canadian cities like they're expendable, which should make every one of us ask a very hard question. If a titan like this can't survive here, what does that say about the ground it's standing on? Be so easy getting your Starbucks fixed tomorrow. The coffee chain is closing hundreds of its stores nationwide, many of them right here in the Southland. Struggling with coffee competition and inflation, Starbucks now is running out of steam, you might say, and laying off hundreds of workers. Let's put the Canadian impact into focus, because this isn't a couple of bad leases or a slow-performing mall location. Starbucks had over EU stores in Canada, and when the restructuring wave hit, nearly 200 of them were marked for closure. That's almost 17% of the entire Canadian network gone or at risk in one sweep. A company of this size doesn't just cut that deep unless the market has stopped making sense, and the fact that Canada was one of the first to feel the blade tells you exactly where we rank on the priority list. Starbucks says it's closing underperforming stores across North America as part of a billion-dollar restructuring plan, and that unfortunately includes the Kingsville location. The store posted a letter on the door saying, "We've made the incredibly difficult decision to close this location by the end of the week." The closures began rolling out in early 2024 and are projected to continue through the end of this year, with major urban centers like Toronto, Vancouver, and Calgary seeing some of the heaviest concentration of shuttered locations. Downtown Toronto alone has seen over 24 stores either close or mark their final operating dates, turning once busy corners into vacant storefronts almost overnight. So, this was in Toronto. Frustrated customers arriving Sunday to find the doors locked. In Edmonton, it appears to impact 4 stores, including the Sunwata location in West Edmonton. Our cameras arriving to find signs noting the closure this morning. And here's where things get serious. Because Starbucks isn't just shrinking in Canada, it hit the global panic button. We're talking about a company that has spent 6 straight quarters fighting declining sales, slashing over 600 stores worldwide, cutting nearly 1,000 corporate jobs, and writing off millions of dollars just to stop the financial bleeding. Their most recent quarterly earnings revealed a 3% drop in same-store sales in North America, with operating margins tightening to levels not seen since the 2008 financial crisis. Sunday, the drapes pulled down, the place deserted, and the doors locked. That means Canada is in collateral damage. It's one of the markets Starbucks deliberately chose to downsize first as a part of this worldwide emergency restructuring to protect profitability. No more devastating coffee drinkers. Starbucks said it's closing 1% of its North American stores. That equates to roughly 400 locations, laying off around 900 non-retail employees, shutting down stores where they were unable to create the physical environment our customers and partners expect, or where we don't see a path to financial performance. Starbucks built its Canadian empire on one core routine: morning commuters grabbing coffee on their way to work. Busy office towers, downtown cores, transit hubs. These locations functioned like daily money machines. When remote work became the new rhythm of the weekday and foot traffic thinned out, the balance shifted, and those high-rent flag stores, now they no longer generated the same volume that made them profitable icons. 3 other stores are no longer listed on the Starbucks store locator, including 99th Street and 34th Avenue, the Orchards location, and the location on 111th Street and Ellerslie Road. The company says it's closing 1% of North American stores and laying off about 900 non-retail employees. And the numbers tell the story clearly. Commercial rent in downtown Toronto has surged by 40% in the past 5 years, while Vancouver's retail lease costs now rank among the highest in North America, often exceeding rates in major U.S. cities like Seattle or Boston. When you're paying $15,000 to $25,000 per month for a prime downtown location, but foot traffic has dropped by 30% or more since 2019, the math just simply stops mathing. Even for a company as large as Starbucks, high rates of incomplete orders in the mid-teens on its mobile app and mobile order and pay has become increasingly important for Starbucks. So people would hypothetically kind of put in an order, see the wait time, or perhaps see the price, and then not complete the order. Here's where the picture becomes even clearer. Because Starbucks didn't just sell coffee, it kind of sold that feeling, and that feeling became expensive. When the average latte crossed the $5 line, Canadians began opening the app, seeing the total, and thinking twice before confirming the order. Recent consumer surveys show that 62% of Canadians have actively reduced spending on premium coffee in the past year, with the majority citing price as the primary factor. Your Starbucks coffee could cost you more starting Tuesday. The company is raising its prices. On average, a Starbucks drink will cost an extra 5 to 20 cents. The price changes will be different depending on where you're at in the country. It's also raising prices of packaged coffee in grocery stores. Meanwhile, grocery store coffee sales have jumped by nearly 18%, and home espresso machine purchases have climbed steadily as consumers invest once in equipment rather than repeatedly in daily cafe visits. Walk through any city right now and you'll notice something interesting. Dollarama is full, discount aisles are busy, and budget chains are expanding. While premium brands are feeling the pressure, there has been a drifting away of people from Starbucks to other cafes to independent coffee shops. And that's a problem because those people aren't necessarily spending less on coffee or beverages. They're just spending less at Starbucks. And Starbucks didn't just raise prices, it reinvented itself. And not everyone felt at home in the new version. Those warm, sit-down cafes where people studied, met friends, and lingered for hours slowly transitioned into fast-pass pickup and go stations built for throughput, not atmosphere. The concept of a third place, that space between work and home where community happens, that's kind of evolved dramatically, and Starbucks no longer owns it. Dude, so busy. That's the crazy thing. That's a crazy thing. I don't know if I don't know what's up, because I'm very new to Starbucks, but I thought that it was pretty damn busy. Meanwhile, thirsty customers still looking for their coffee. We're closed. Sorry. Co-working spaces, public libraries with coffee bars, and even redesigned fast food chains now offer what Starbucks once monopolized: a place to sit, connect to the Wi-Fi, and settle in. Gen Z consumers in particular show different habits than the millennials who built Starbucks into a lifestyle brand. They're more likely to order ahead, grab and go, or skip the cafe entirely in favor of energy drinks and ready-to-drink alternatives that cost almost half as much. But how much are they making per cup? They're charging $5.75. That means they're making $4.75 on a basic latte. And that's not even a specialty drink. Tim Horton shows exactly how consumer preference has shifted not away from coffee, but towards cheaper, closer, familiar options. Where Starbucks positioned itself as premium and aspirational, Tim's remained the everyday cup. Simple menu, lower price, and a presence in every corner in the country. In an economy where Canadians prioritize practicality, the brand built for lifestyle meets the brand built for habit, and habit wins. Now take a look at the cost of a latte from McDonald's. It's up over 40% during the same time period. While that increase is a lot higher, it's still cheaper than Starbucks. So more attractive to a price-conscious consumer. That matters because Starbucks now has to increasingly compete as a value player. But Tim Hortons isn't the only player capitalizing on this shift. McDonald's McCafe has quietly expanded across Canada over the past 2 years, adding espresso-based drinks at price points 20 to 30% below Starbucks, while leveraging thousands of existing locations with drive-thrus and extended hours. Relies heavily on the morning time on people grabbing their coffee in the AM before they head into work. If they're not doing that as much, it's bad news for Starbucks. It's also the case, Janala, that a lot of people like me have started making coffee at home now where they haven't before. That's a trend that could continue. Even independent coffee shops, the ones Starbucks once threatened to extinction, are finding renewed life as consumers seek authentic local experiences that feel personal rather than just transactional. Market data shows that local cafes gaining a 12% increase in customer loyalty over the past 18 months. That's a reversal that would have seemed impossible a decade ago. Starbucks is forming a joint venture with Chinese alternative asset management firm Boyu Capital to operate the coffee chain's locations in China. That deal is valued at $4 billion. Boyu will hold up to a 60% interest in the joint venture, with Starbucks holding the 40% stake. Starbucks isn't stepping back everywhere. In fact, while Canada tightens, India and China are heating up and pulling massive investment. Demand in those markets grows fast. Competition is fierce, and every store added or upgraded there carries long-term upside. When a brand sees more growth potential abroad than at home, strategy naturally shifts towards expansion, where momentum runs strongest, and Canada becomes the market where footprint right-sizes, not where it scales. Employees say they found out about the closure on Thursday and Saturday was their last day. Another layer of this story lives behind the counter with the workers who brewed the coffee, cleaned the floors, and carried the brand every day. Many of them received very short notice before closure, and some only discovery change through the app or a sudden schedule wipe. Minimum wage has increased across most Canadian provinces, with Ontario now at $16.55 per hour, British Columbia at $17.40, $40 in Alberta at $15, representing significant jumps over the past 5 years. The recognizable logo gone and a note left on the door. 2 Waterloo locations impacted. The company closing stores that are underperforming, but the quick closure leaving regular customers confused. I was a little bit surprised. It's just so sad because we would go here all the time and the one on campus always has such a long line. So, it's just such a sad, sad thing to see. Add in provincial healthcare contributions, benefits packages, and the cost of training high turnover staff, and the labor expenses per store have climbed sharply. Unionization efforts have gained momentum too, with successful votes at multiple Canadian locations, and workers pushing for better scheduling stability, wage guarantees, and protection against sudden closures, all of which add complexity and cost to operations that were already under margin pressure. Trying to go from being a third place where people wanted to kind of hang out to being a convenience place. Well, then suddenly you're competing with McDonald's and convenience stores, and the uniqueness of your proposition is watered down. A Starbucks location isn't just a cafe. It often acts as an anchor for the entire block, attracting steady foot traffic and giving nearby small businesses a reliable customer flow. When that anchor moves out, the ripple is immediate. Less walk-in traffic for the bakery next door, fewer lunchtime customers for the sandwich shop, and slower turnover for the boutique across the plaza. One logo leaves a window and the entire commercial rhythm of that corner kind of shifts with it, calling it your coffee house and a place woven into your daily rhythm. The closure is part of an overall location reduction of 1% within Canada and the United States that was announced. Vacancy rates in retail corridors have already climbed 8% in areas where Starbucks shut down, and property values are softening as foot traffic drops and smaller tenants struggle. When an anchor brand leaves, it shakes confidence in the entire block, influencing lease negotiations, investment decisions, and long-term commercial outlook. Starbucks pullback. It kind of fits a broader global pattern. When the company reevaluating urban markets based on sustainability, store performance, and operational pressure. When a multinational shifts its footprint, it signals not just a change in coffee culture, but a new way that companies measure growth versus risk. Always like super nice and welcoming, and I feel like so bad that they all just lost their jobs so suddenly. So it's just really disappointing. I didn't know anything about this happening. So, I hope they can find an alternative soon. Mark Carney's frustration speaks loudly, but Starbucks' closure, I think it speaks louder. While the government talks about growth and stability, a global brand is quietly cutting locations and redirecting capital, offering a very different reading of the economy. When leadership promises progress, but storefronts disappear, well, people stop listening to speeches and start watching real life in the vacant windows, in the reduced spending, and in the shrinking footprints. Starbucks' stock price peaked in July of 2021 at over $125 per share after having tanked with the rest of the market during the pandemic. The start of 2022 led to a sharp decline in its share, and Starbucks pulling back isn't just a snapshot of where we are, it's a preview of where we're heading. A company of this size reassessing entire regions signals a shift towards cheaper markets, scalable models, and consumer spending that no longer matches the old map. If Starbucks is the warning signal, which industry gets hit next? These closures suggest a wider shift. Canadians now buy with caution, choosing value over premium routine. When a brand built on daily lattes pulls back, it raises a simple question. Have we already changed the way that we spend without realizing?